Okay, so um, let's crack open this stack of material we got. A listener is asking some really big fundamental questions here. Money, credit, economics. The whole works.
Yeah, and the core of it takes us right into a pretty significant text.
Right. Ludwig von Mises, Theory of Money and Credit.
That's the one, written, what, 1912? But still incredibly sharp. Some insights feel, well, very relevant right now.
Absolutely. So the plan for this deep dive,
Yeah.
it's not about reading you the whole book, obviously.
No, definitely
It's
not.
more about pulling out the really crucial ideas, those aha moments, the things that might actually change how you think about what money is, why its value shifts around so much.
And how governments and banks fit into that picture, sometimes in, well, surprising ways.
Yeah, expect some common assumptions maybe to get a bit of a shakeup.
Mises really pushes you past the labels, the legal stuff, to the economic reality underneath.
Okay, let's jump in. Mises starts with something that sounds simple, almost too simple maybe. What's money's number one job, according to him?
At its absolute core, it's a medium of exchange. That's its primary reason for being. It's what lets us trade easily in a complex society.
Right, avoids a whole barter mess.
Exactly. Finding someone who wants exactly what you have and has exactly what you want, it's a nightmare. Money solves that.
Like the shoemaker wanting bread example.
Yeah.
You sell shoes for money, buy bread with money. Simple.
Right. And Mises argues, and this is key, that other things we think money does, like saving, hoarding value for later, or moving wealth across the world.
Yeah.
Those aren't really separate functions. They all kind of flow from that main job as a medium of exchange.
How so? Give me an example. Moving wealth, how's that just exchange?
Well, the classic example in the source is the European farmer moving to America.
Okay.
They don't ship their cows, right? They sell a farm, get money, travel, then use that money in America to exchange for a new farm, new animals. The money was just the easiest way to make that exchange happen across space.
Ah, I see. And saving works because you trust you can exchange the money later.
Precisely. The exchangeability is the root of it all.
Okay. But what about, paying taxes, paying off a loan? Isn't that a medium of payment? That feels a bit different.
Mises draws a sharp line there. He says thinking of it primarily as a general medium of payment is more of a legal viewpoint, a juristic view.
Focused on settling debts legally?
Yeah, how obligations get cleared in the eyes of the law. But Mises says, well, economically, that overlooks the deeper reality, which is that even paying a debt is usually just completing an exchange that started earlier. You got goods or a loan.
And now you're holding up your end of the bargain with money.
Exactly. The payment is economically part of the exchange. The source even quotes someone basically saying, if you get money's role in all dealings, buying, selling, capital, you don't need a separate payment function. It's covered.
So economics looks at the whole flow.
Yep.
Law focuses on the settlement point.
Got it.
Yeah.
Now, if it's not just for paying, is it like a production good, like a machine? Does it help make stuff? Mises says no, definitely not. He argues you can actually have production without money. Think of like an isolated family farm making everything itself, or some theoretical socialist community.
Hey.
Money doesn't directly help create goods like a tool does.
But wait, transportation helps production, right?
Yep.
Moving materials, moving finished goods, that seems essential.
Exactly. Transportation is physically part of getting goods where they need to be. Money doesn't do that physical work. The source mentions these. He had 3 categories: consumption goods, production goods, and media of exchange. Mises puts money firmly in that third box. Production can happen without it. Money facilitates the exchange of produced goods, but isn't a factor in the production process itself. Its value works differently.
Okay, so number one job,
Yeah.
exchange. Not payment per se, not production.
Huh.
That clears things up. But then, the big one, how does this stuff, shells, gold, digital numbers, how does it get value?
Right. This is central for Mises. Value always comes from subjective valuation, meaning it's not baked into the object itself.
Yeah.
It comes from individuals deciding how important something is to them based on their needs, their situation.
What matters most to me, right?
Exactly. The source uses that analogy of the guy with cows and horses, isolated guy. Maybe one horse is worth more than one cow to him if he has to choose one.
Okay.
But if his whole herd is at risk, maybe the total group of cows is more valuable than the total group of horses. Value depends on the specific choice, the specific unit, the marginal unit.
So how does that work for money? I don't use money directly like a horse or cow.
You value money because of what you expect you can exchange it for. And here's the crucial bit from Mises. You can only make that subjective valuation of money because there are already exchange ratios prices out there in the market. You have a sense of what a dollar can buy today because of all the exchanges and valuations that happened yesterday.
So I accept the dollar because I know roughly the market already values it at a coffee or some bus fare based on recent history.
Exactly. And this leads to one of his most famous ideas, sometimes called the regression theorem. It's about how money's value today isn't just created fresh. It actually depends on what people expect it to be worth tomorrow,
Okay.
which is based on what it was worth yesterday and the day before. It traces back.
Backwards in time.
Yeah, like a chain, all the way back to when the thing first used as money, gold, silver, whatever, had value just for non-monetary reasons, like making jewelry or tools.
So that initial non-money value is the anchor.
That's the idea. That historical link, that continuity is what makes subjective valuation of money possible today. Its value today is connected through time back to that original commodity use.
That's just, yeah, that's a different angle. Not just today's supply and demand snapshot. It's historical.
Yeah.
What about the simpler idea, though? The quantity theory. More money equals less value, right?
Mises definitely acknowledges the basic link. Changes in supply or demand do affect value, but he really pushes back against the overly simplistic, mechanical versions.
Like double the money, double the price is half the value.
Exactly. He says that ignores the whole subjective valuation thing we just talked about.
How so?
Well, if you suddenly get, say, an extra $1,000, does your value for each dollar instantly halve? No. It depends on your situation, what you plan to do with it. New money doesn't spread evenly. It hits different people, different prices, at different times, changing their subjective views first.
Right. The person getting the new money first has a totally different experience than someone just seeing prices go up later.
Exactly. It ripples through by changing individual choices and valuations, not by some automatic formula.
Does the actual material, like gold, still matter once it's used as money? Does industrial demand affect its monetary value?
Mises thinks about that.
Yeah.
He suggests, yeah, the monetary use probably does feed back and affect the overall value of the material. Part of the gold stock is money, part is for industry. Changes in one area likely influence the other.
Okay.
He also points out, if you say money's value is only based on non-monetary uses, well, how do you explain paper money? Fiat money. The paper itself is almost worthless otherwise.
Good point.
So yes, that historical link to commodity value was crucial for money to start, but the ongoing use as money continues to shape the material's total value.
Okay, so exchange is key, value is subjective and historical. Quantity theory needs nuance. Let's bring in the state. Governments love messing with money, don't they?
They certainly get involved. Mises saw a lot of state economic policy, especially moving into the 20th century, as really clashing with 19th century ideas of free trade, international cooperation, more protectionism, seeing imports as bad.
Looking inward.
Yeah, relying more on state power. And the monetary system often gets caught in the middle. He also points out how the law often pretends money has a stable, fixed value.
Right, a dollar is a dollar.
Which economically is just a fiction, as the source calls it. Purchasing power changes constantly. The law might say paying $100 settles a $100 debt, but it ignores what that $100 can actually buy compared to before.
The law sticks to the number. The economy looks at the real value.
Exactly. And states intervene directly, obviously, controlling mints, shifting standards, like Germany moving to gold after the Franco-Prussian War, helped by that big French payment in gold. Or, just declaring paper notes that aren't backed by anything as legal tender.
When they start doing that, issuing paper you can't redeem for gold,
Yeah.
is the goal always to just switch to paper money?
Mises argues often, no, not initially. The main driver is usually fiscal.
They need cash.
They need money to pay for things, and they can't or won't raise enough through taxes or borrowing. Printing is easy.
It's the path of least resistance for spending.
Right. But the unavoidable economic result is that the paper money loses value. It depreciates. And that depreciation, Mises says, is what often leads to the change in the system because of Gresham's law.
Bad money drives out good.
Yeah. People hoard the stabling money, like gold, and spend the paper that's losing value. So the paper takes over, even if the state didn't originally want it to fully replace the metal standard, maybe just circulate alongside it.
So the state prints to spend, the money tanks, and the public's reaction forces the system change.
Wow. Exactly. And this connects to his idea of etatism.
Etatism.
Yeah, basically the belief in the all-powerful state, the desire for the state to control everything. Economically, that means things like nationalizing industries and, crucially, price controls.
Setting maximum prices.
Yes, which Mises argues is the disaster. If the price is forced below the market level, well, sellers stop selling, or things go underground, black markets pop up.
Shortages.
Shortages, queues, chaos. It breaks down the whole system of exchange that relies on real prices and can lead towards, well, economic collapse. History shows attempts to fix prices generally fail.
He really connects state intervention, especially price controls, directly to breakdown. That's stark. Are there ever political arguments for inflation? Why would anyone want it?
Well, nobody argues for it publicly in those terms, usually. But Mises suggests the sort of hidden political calculation is sometimes that inflation is seen as a, quote, lesser evil to avoid some other perceived disaster, even though he thinks inflation brings its own disaster.
And what drives it more recently, or the modern context he was observing?
He flags two big things. One, those fiscal needs governments want to spend more than they tax, especially when taxing the rich heavily is politically tricky.
Okay.
And two, the full employment policy, using monetary expansion, creating credit to try and push wages higher than the market would naturally set them.
Printing money to prop up wages.
In effect, yeah. And inflation also creates these pseudo-profits.
Fake profits.
Kind of profits look high just because all prices are rising, but it's not real growth.
Yeah.
Then the state taxes those inflated profits, which actually eats into real capital. Plus, inflation gives a great excuse for price controls. See, prices are out of control, we must step in. And it helps shift blame for rising prices onto, greedy speculators instead of the government's monetary policy.
Wow. So it's a tool to spend, creates an illusion, taxes away real wealth, and provides political cover. That's quite the take on the politics of inflation.
It's definitely looking at the functional effects of inflation, suggesting it serves political and fiscal ends, not just abstract economic ones.
Okay, shifting from the state itself to the banks. How do they fit in? And what's this idea Mises has about fiduciary media?
Right, banks. First, he distinguishes economically between savings accounts, which are more like investments you make in the bank, and current accounts, checking accounts. Those are held mainly for making payments.
Different purposes for the user.
Yeah. And things like clearing systems where banks settle up between themselves, and especially the use of fiduciary media, mean we need way less physical cash changing hands.
Which is efficient.
Hugely efficient. It also stopped the value of gold, say, from skyrocketing as economies grew and needed more means of payment.
Okay, so fiduciary media. The source says it's from unlaw-smitten circulating stuff. What is it exactly?
It's things that act like money, pass hand to hand, but aren't fully backed by the real base money, like gold reserves historically or central bank reserves today.
Right.
Uncovered banknotes were the classic example notes issued beyond the gold in the vault. But even more important today, bank deposits. The
Right.
numbers in your checking account that the bank doesn't hold matching cash for.
So it's money based on trust, fiduciary, but there isn't enough real money for everyone to cash out at once.
Exactly. It's created when banks extend credit. They essentially swap a newly created deposit, a claim for the borrower's promise to pay later. And Mises warns, if banks aren't restricted and they all act together, they could potentially create this stuff without limit.
Just keep lending and creating deposits.
Potentially. And that, of course, massively dilutes the value of all money.
This sounds like those old debates, currency school versus banking school.
Exactly. Back in the 19th century, currency school said, whoa, restrict those banknotes based on gold or you'll get inflation. Banking school said, nah, it's fine. Excess notes will just come back to the bank.
And Mises.
He critiqued both, but he thought the currency school was onto something important about the danger of overissuing. But he said their big mistake was focusing only on banknotes.
They missed.
They missed that bank deposits created through lending do exactly the same thing. They expand the circulating medium just like notes do, maybe even more so.
So Mises was saying, you're arguing about paper, but look at the checking account.
Pretty much. He saw deposit creation via lending in fractional reserve banking as the main engine.
Yeah.
He also talks about the discount rate, the interest rate banks charge.
Yeah.
Banks have to keep their rates somewhat aligned. If one bank lends too cheaply, people might pull money out, demanding cash, risking the bank's solvency. So raising the discount rate is a way to hit the brakes, limit the creation of this unbacked fiduciary media.
A control mechanism. What about that gold premium policy mentioned for the Bank of France?
That was them trying to keep French interest rates low, even if rates were higher elsewhere, by making it costly or hard to get gold out of France. Mises saw that as undermining the gold standard itself. You interfere with the gold flow that's supposed to discipline things, you end up depreciating your currency and moving towards fiat money.
Interfering with the checks and balances. And central banks, like the Fed.
Mises saw that once you get powerful central banks, especially post-WWI, controlling huge gold reserves, the price of gold itself stops being purely market-driven.
How so?
Because the central bank's policies, buying gold, selling gold, managing flows, heavily influence its price. Gold is no longer fully independent of government policy. That changes a fundamental aspect of the classical gold standard, its independence.
So even with the gold link, the central bank can still manage the value. Interesting. A World Bank is mentioned too, briefly.
Mises was pretty skeptical. Big problems with international law, the risk of countries freezing assets, basically trusting a supranational body with your core monetary control. Probably not going to happen.
Makes sense. Okay, so state actions, bank credit creation, they change money's value. What are the results of that, socially, economically?
The main result, Mises emphasizes, is redistribution. Changes in money's value don't make society richer overall. They just shuffle wealth and income around between different people.
How does that shuffling happen?
Well, whoever gets the new money first or sees their prices go up first wins initially. They spend the new, less valuable money while other prices are still low.
And the losers?
Are those who get the money later or whose incomes or prices lag behind. Think of someone on a fixed pension or workers whose wages don't keep up with rising prices. Entrepreneurs might gain temporarily if their selling prices rise faster than their costs, like wages set by contract. But that gain comes from someone else's loss.
It's not an even lift. It churns things up. What about interest rates?
Short-term, Mises says, falling money value inflation can actually push nominal interest rates up. Why? Because borrowers, like those entrepreneurs expecting higher prices, are willing to pay more interest. If money's value is rising, rates might temporarily fall. Long-term effects depend on how the redistribution impacts saving and investment, basically capital accumulation.
And trade between countries.
If a currency loses value but the exchange rate doesn't adjust instantly, exporters might get a temporary boost. They sell abroad for foreign currency that converts back into more of their depreciated home currency while their costs haven't fully risen yet. Creates temporary distortions and profit chances until everything realigns.
The winners, losers, shifts in borrowing costs, weird trade effects. How do we even track these value changes? Price indexes.
Mises wasn't a huge fan of index numbers as a perfect theoretical measure. He saw them as flawed approximations.
But useful.
Practically useful, yeah, especially for comparing short periods or getting a rough sense of trends. He makes an interesting point, though. He argues money's actual purchasing power is the same everywhere.
Wait, how can that be? Cost of living varies hugely.
His point is, the difference isn't in the money's value itself, but in the goods. The cost of living is higher in City A than Town B because the goods in City A, including the location aspect, local taxes, transport costs to get things there are different or cost more to provide there. It's the basket of goods that differs, not the abstract purchasing power of the dollar itself.
That's a subtle but important distinction. Okay, given all these issues, state meddling, inflation, redistribution, what's the alternative? What system does Mises favor?
He's a strong supporter of the classical gold standard.
Why gold?
Primarily because it acts as a major check on the government's ability to inflate the money supply. The amount of gold isn't determined by politicians. It's determined by, mining realities and market demand for monetary versus industrial uses.
Takes the printing press away from politics.
That's the core idea. The source uses this hypothetical Ruritania example for reform. You'd fix the currency rigidly to gold, or maybe a stable gold-backed currency like the dollar was then. And crucially, the government could only spend what it gets from taxes or real borrowing from the public.
No more creating money out of thin air to pay bills.
Exactly. Convertibility would need to be managed by maybe an independent agency. The goal is an unbreakable barrier against the state just inflating the money supply whenever it wants. He argued that under such a system, worries about trade deficits tend to fade because imports ultimately have to be paid for by exports limited by real production and earnings.
That sounds radically different from how most systems work today with central banks managing fiat currencies. So Mises sees the whole state of money as tied to duper philosophies.
Yes, that's his powerful conclusion. He points out this paradox. People hate inflation's effects, rising prices, eroding savings.
Yeah, constantly.
But often they support the very government policies causing it, like deficit spending or programs funded by easy credit. And they resist the measures, like spending cuts, needed to stop it.
Wanting the benefits funded by inflation, but not the inflation itself.
Exactly. So for Mises, getting back to sound money isn't just a technical fix. It needs a fundamental change in the whole philosophy of government and economics away from what he saw as prioritizing spending, state control, and ultimately eating away at capital. The gold standard worked, in his view, because it imposed a discipline that managed fiat systems lack.
This has been, well, a really challenging look at some deep ideas. Money as exchange, value being subjective and historical, the huge impact of state and banks, often negative, leading to redistribution, capital consumption,
Yeah.
and this case for sound money as a check on power.
Yeah, grasping these Misesian fundamentals gives you a very different, very powerful lens for looking at economic news and policy today.
It really does. And it leaves us with a pretty provocative thought, maybe an uncomfortable one, to chew on. If Mises is right that inflation is often used politically funding spending beyond taxes, creating fake profits to tax, distracting from real problems, then how much of today's economic policy and debate is genuinely about creating sustainable prosperity versus how much is maybe more about, well, maintaining political structures and masking deeper issues by manipulating the money itself? It makes you wonder how often we accept explanations for economic problems without questioning the very nature and stability of the money that underlies it all. Something to think about.